At 4:47 a.m. Eastern Time on Tuesday, the Iranian Revolutionary Guard Navy announced the closure of the Strait of Hormuz to all commercial traffic. Within 90 minutes, 2 Greek-flagged tankers were seized. Within 3 hours, a Singaporean container ship was turned back by Iranian fast boats. Within 6 hours, Lloyd's of London suspended maritime insurance for all vessels transiting the Persian Gulf. The most important choke point in global commerce, the 21-mile-wide passage through which 21% of the world's oil and 25% of its liquefied natural gas flows every single day, is now closed. Not threatened, not restricted, closed. And as I record this video 72 hours into the crisis, with no diplomatic resolution in sight, with carrier strike groups moving into position, with oil already at 147 per barrel, I need to explain to you why every single day the Strait of Hormuz remains closed brings silver approximately 10% closer to $120 per ounce. This is not hyperbole. This is not clickbait. This is the mathematical reality of what happens when you sever the arteries of global industrial production. Silver is not just a monetary metal, it is an industrial metal, and the industrial system that consumes 663 million ounces of silver per year is now facing the most severe supply chain disruption since World War II. Let me show you exactly what's happening, exactly why silver is at the center of this crisis, and exactly what price levels become mathematically inevitable if this closure extends beyond the next 2 weeks. Let me give you the geopolitical context because understanding the trigger matters. The closure came in response to Israeli airstrikes on Iranian nuclear facilities that occurred Monday night. Those strikes, reportedly conducted with American logistical support, destroyed 3 enrichment facilities and killed an estimated 200 Iranian personnel. Iran's response was not a direct military attack on Israel, it was economic warfare. They closed Hormuz. The message was clear. If you attack our infrastructure, we will shut down the infrastructure that powers the global economy. The closure is being enforced by a combination of naval vessels, anti-ship missile batteries along the Iranian coastline, and the implicit threat of mining the strait. The U.S. Fifth Fleet, based in Bahrain, is now inside the Persian Gulf. But transiting the strait under fire is not the same as keeping it open for commercial traffic. Insurance companies have already made that distinction. No commercial vessel will transit without insurance, and no insurer will underwrite the risk while Iranian missiles are active. The immediate economic impact is oil. Brent crude opened Tuesday at $89. By Wednesday close, it was $127. As I record this Friday morning, it's at $147 and climbing. Every analyst on Wall Street is focused on energy. Every headline is about gasoline prices. Every politician is talking about strategic petroleum reserves. But almost nobody is talking about silver. And that's a mistake, because what's happening in the energy markets is about to cascade through the industrial supply chain in ways that make silver not just a beneficiary of the crisis, but a critical bottleneck that will force prices dramatically higher. Let me explain the first-order effect because energy prices directly impact silver mining costs. Approximately 30% of silver mining costs are energy-related: diesel for haul trucks, electricity for processing plants, natural gas for smelting. When oil goes from $80 to $147, an 84% increase, mining costs rise approximately 25 to 30%. The all-in sustaining cost for the average silver mine moves from $20 per ounce to approximately $25 to $26 per ounce. Marginal mines that were profitable at $32 silver are suddenly unprofitable. They curtail production or shut down entirely. Mexico, the world's largest silver producer at 190 million ounces per year, imports over 70% of its refined petroleum products. Peru, the second largest producer at 120 million ounces, imports approximately 50% of its diesel. Argentina, Chile, and Bolivia all have significant import dependencies. The Hormuz closure doesn't just affect Middle Eastern oil. It removes 21% of global oil supply from the market, creating shortages and price spikes that ripple to every importing nation. Mexican silver mines are not being bombed. but they're about to experience fuel shortages and cost explosions that will reduce their output. The supply side of the silver equation just got hit by a torpedo. Let me explain the second-order effect, because this is where the industrial supply chain fractures. The Strait of Hormuz doesn't just carry oil, it carries approximately 25% of global LNG exports. Qatar, the world's largest LNG exporter, ships almost all of its gas through Hormuz. That gas powers manufacturing facilities across Asia, including the semiconductor fabs in Taiwan, the solar panel factories in China, and the electronics assembly plants in Vietnam and Malaysia. It powers the steel mills in South Korea and Japan. It powers the refineries that produce the chemicals used in silver-consuming industries worldwide. When LNG supply drops by 25% globally, industrial facilities don't just pay more, they shut down, they ration, they prioritize critical operations and cancel discretionary production. The cascade effect is impossible to model precisely, but the direction is clear. Less industrial activity in the short term, followed by panic restocking once supply normalizes. Here's where silver enters the equation. Solar panel manufacturing consumes approximately 232 million ounces of silver per year. The silver goes into the conductive paste that forms the electrical contacts on photovoltaic cells. This paste is applied in nanometer-thin layers using equipment that requires precise calibration and consistent supply. If a solar panel factory in China loses access to reliable electricity because LNG supply is disrupted, they don't just produce fewer panels. They may damage equipment. They may lose calibration. They may require weeks to restart once power stabilizes. The immediate effect is reduced silver consumption as factories idle. But the secondary effect, once the crisis resolves, is panic buying. Every solar manufacturer will want to rebuild inventory. Every supply chain manager will want buffer stock. The just-in-time delivery model that has dominated manufacturing for 30 years will be questioned, abandoned, and replaced with just-in-case stockpiling. That stockpiling will create a demand surge that hits a market already in structural deficit. Let me explain the third-order effect, because this is where monetary demand explodes. A Hormuz closure is not just an oil shock, it is a geopolitical earthquake. It means the United States and Iran are in direct confrontation. It means the risk of regional war, potentially involving Israel, Saudi Arabia, and other Gulf states, has spiked to levels not seen since 1991. It means the dollar, as the currency of a nation potentially entering another Middle Eastern conflict, faces credibility questions. It means inflation, already elevated, is about to spike as energy costs flow through to every good and service. In this environment, investors flee to hard assets: gold, silver, commodities, anything that cannot be printed, cannot be sanctioned, cannot be frozen by a government decree. We saw this during the 1979 oil shock. We saw it during the Gulf War. We saw it after 9/11. Geopolitical crises trigger safe haven buying. And silver, as both an industrial metal and a monetary metal, benefits from both the inflation hedge demand and the supply disruption premium. Let me give you the numbers on what's already happening, because the market is moving faster than the headlines. On Monday, before the strikes, silver closed at $32.47. By Tuesday close, after the Hormuz announcement, silver was at $36.82. By Wednesday, $41.17. By Thursday, $44.93. As I record this Friday morning, spot silver is at $47.28. That's a 45.6% increase in 4 days, and we're just getting started. The market is pricing in the first order effects, energy costs, mining disruptions, and general safe haven demand. It is not yet priced in the second-order effects, industrial supply chain fractures and manufacturing shutdowns. It is not yet priced in the third-order effects, panic restocking and just-in-case inventory building, and it has certainly not priced in the fourth-order effect. What happens if this crisis escalates into actual military conflict between the US and Iran? Let me walk you through the escalation scenarios, because the path to $120 silver runs through each of these gates. Scenario 1. Diplomatic resolution within 1 week. This is the best case. Back-channel negotiations produce a face-saving off-ramp for Iran. The strait reopens. Oil prices fall back to $100 or $110. Silver retreats to $38 to $42 as panic subsides. The crisis is remembered as a scare, not a catastrophe. Probability, 15–20%. Scenario 2, closure extends 2 to 4 weeks, no military escalation. This is the base case that most analysts are modeling. Iran maintains the closure as leverage. The U.S. deploys additional naval assets, but does not attack. Negotiations continue. Oil stabilizes at $130, $150. Silver reaches $55, $65 as industrial users begin emergency stockpiling and investment demand remains elevated. The economic damage is significant but contained. Probability 40–45%. Scenario 3, closure extends beyond 1 month, limited military exchange. This is where things get dangerous. After 3 to 4 weeks of closure, economic pressure forces military action. The U.S. conducts strikes on Iranian missile batteries and naval assets. Iran retaliates with missile attacks on Gulf oil facilities and possibly on U.S. bases in the region. Oil spikes to $180–200. Silver breaks $80 as both industrial panic and monetary flight accelerate. The global economy enters recession. Supply chains fragment along geopolitical lines. Probability 25–30%. Scenario 4, regional war involving multiple nations. This is the tail risk that markets are not pricing. Israel conducts additional strikes. Iran attacks Saudi Arabia. Houthi forces in Yemen close the Red Sea simultaneously with Hormuz. Global shipping is paralyzed across 2 critical choke points. Oil goes to $250+. Silver, as one of the few liquid hard assets available, goes to $100, $120, potentially $150 as the monetary system itself comes into question. Probability 10–15%. Let me do the math on each scenario because I want you to see how the 10% per day framework emerges. Currently, silver is at $47.28. In scenario 2, the most likely outcome, silver reaches $55 to $65 over 2 to 4 weeks. That's approximately 17 to 38% additional upside from current levels. If we assume linear progression over 20 trading days, that's 0.81.9% per day, less than 10% because the base case is relatively contained. In scenario 3, silver reaches $80 over 4 to 8 weeks. From current levels, that's 69% additional upside. Over 30 trading days, that's 2.3% per day average, but the moves would not be linear. They would come in spikes around escalation events, with single-day moves of 8 to 15% entirely possible. In scenario 4, silver reaches $100, $150 over 2 to 4 months. From current levels, that's 111 to 17% additional upside. The daily moves in this scenario would be erratic but would average well above 2% per day with frequent 10% plus single-day spikes. When I say every day the strait stays closed brings silver 10% closer to $120, I'm not claiming silver will rise 10% every day. I'm saying that each day of closure increases the probability of scenario 3 or 4 materializing. Each day increases the economic damage that must be repaired when the crisis ends, and each day brings the ultimate price resolution closer to the higher scenarios. Let me explain the physical market dynamics because this is where the immediate pressure is building. Within hours of the Hormuz announcement, I received messages from 3 different dealer contacts. All 3 reported the same thing. Their phones were ringing off the hook. Orders were flooding in at a pace they hadn't seen since March 2020. By Wednesday afternoon, 2 of the 3 had suspended online ordering because they couldn't keep their websites updated with accurate pricing and inventory. By Thursday morning, premiums on Silver Eagles had expanded from $6 over spot to $14 over spot. Premiums on generic rounds had expanded from $3 to $8. One dealer told me they had sold more silver in 48 hours than in the previous 2 months combined, and they were running out of inventory to sell. The retail market is a leading indicator. When retail demand spikes, it signals that ordinary people are seeking safety. It signals that the monetary demand component of silver is activating, and it signals that whatever inventory exists in the system is being rapidly absorbed. The wholesale market is telling the same story. The Shanghai premium over COMEX, which had been running $5 before the crisis, spiked to $12 on Wednesday and $18 on Thursday. Chinese industrial users are panic buying. They're securing inventory before supply chains fracture further. They're paying whatever premium is necessary to guarantee delivery. The LBMA in London reported unusual tightness on Wednesday, with several large orders unable to be filled at quoted prices. The paper market is moving fast, but the physical market is moving faster. The divergence between paper and physical, which I've discussed many times on this channel, is now widening in real time under crisis conditions. Let me give you the historical parallels because this has happened before and the results were dramatic. The 1973 Arab oil embargo, triggered by U.S. support for Israel during the Yom Kippur War, saw oil prices quadruple from $3 to $12 per barrel. Silver, which was trading at approximately $2.50 before the embargo, rose to $6.70 by the end of 1974, a 168% increase in approximately 14 months. The 1979 Iranian Revolution and subsequent hostage crisis, combined with the Soviet invasion of Afghanistan, created a perfect storm of geopolitical uncertainty. Oil went from $15 to $39. Silver went from $6 to $49 between January 1979 and January 1980, a 717% increase in 12 months. The current crisis has elements of both. It has the oil supply shock of 1973. It has the geopolitical uncertainty of 1979. It has the potential for military escalation that neither of those crises fully realized. And it's occurring in a silver market that is already in structural deficit, with COMEX inventories at 15-year lows and industrial demand at all-time highs. The setup is more bullish than either 1973 or 1979. Let me address the demand destruction argument because some analysts claim that high prices will simply kill demand. This is true at the margin. If silver goes to $100, some jewelry demand will be destroyed, some industrial users will seek substitutes, some investors will take profits. But the timeline for demand destruction is measured in years, not weeks. Solar panel manufacturers cannot reformulate their conductive paste in 2 weeks. Electronics manufacturers cannot redesign their circuit boards in 2 weeks. Industrial demand is locked in by existing designs, existing contracts, and existing production schedules. They will pay $60, $80, $100 per ounce before they can implement alternatives. And even then, silver's unique properties, its electrical conductivity, its thermal conductivity, its antimicrobial properties, make substitution difficult or impossible for many applications. The demand destruction that eventually balances the market will come, but it will come after prices have spiked far higher than current levels. The inelasticity of short-term industrial demand is what creates the potential for explosive price moves. Let me tell you what I'm doing because I believe in transparency about my actions. On Tuesday morning, within 2 hours of the Hormuz announcement, I placed the largest single silver order of my life. I had been holding approximately 15% of my precious metals allocation in cash, waiting for a buying opportunity. I deployed 100% of that cash into physical silver at 37.40 spot, paying premiums that brought my effective cost to approximately $42 per ounce. By Friday, that position is up 12.6% in 4 days. I'm not selling, I'm holding, and I'm considering deploying additional capital from non-precious metals allocations if the crisis extends. I also added significantly to my mining stock positions on Tuesday and Wednesday. First Majestic, Hecla, and Pan American all gapped higher at the open, but I added anyway because I believe the miners have not yet priced in the full magnitude of what's happening. If silver goes to $80, these miners will triple or quadruple from current levels. The entry price on Tuesday is less important than being positioned for the move. I've also taken defensive actions. I've increased the physical security at my storage locations. I've moved some metal from one location to another to diversify geographic risk. I've confirmed that my insurance coverage is adequate given the new valuations, and I've had conversations with family members about contingency plans if the crisis escalates into something larger. This may sound dramatic, but a Hormuz closure is not a drill. It is a genuine geopolitical crisis with the potential to reshape the global order. Taking prudent precautions is not paranoia, it's responsibility. Let me give you the technical picture because the charts are confirming the fundamental thesis. Silver broke above its 2024 high of 34.87 on Tuesday. It broke above its 2021 high of 35 years ago, but this week it broke above resistance levels that have contained the price for years. The 35.36 zone that had been resistance is now support. The next major resistance is the 2011 high of $49.82. We're at $47.28. We could test $50 within days if the crisis continues. Above $50, there is no significant resistance until the 1980 high of $49.45, which has already been exceeded in intraday trading this week. Above $50, the chart is open air. There's no historical resistance to slow the move. The technicians who trade based on chart patterns will become buyers, not sellers, above $50, because the breakout signals trend continuation. The technical picture is as bullish as the fundamental picture. Let me address the people who think this will blow over because I understand the temptation to assume normalcy. Every crisis in our lifetimes has eventually resolved. The 1991 Gulf War ended. The 2008 financial crisis passed. The COVID pandemic faded. There's a cognitive bias toward assuming that the current crisis will follow the same pattern. Maybe it will. Maybe Hormuz reopens next week and silver retreats to $35. Maybe this is all a buying opportunity in reverse, a chance to sell into panic rather than buy. I cannot rule that out. But I can tell you that the structural setup for silver, independent of this crisis, was already bullish. The 4-year deficit, the 15-year inventory low, the record industrial demand, the emerging institutional adoption, these factors existed before Hormuz. The crisis is an accelerant, not the fuel. Even if the crisis resolves quickly, the structural factors remain. The price may retreat from $47, but it's unlikely to return to $32. The crisis has shifted expectations. It has demonstrated silver's role as a crisis asset. It has drawn attention to the supply vulnerabilities. The baseline has moved higher, regardless of how the immediate situation resolves. Here's what I want you to take from this video. First, the Strait of Hormuz closure is not a drill. It is a genuine geopolitical crisis with significant probability of escalation. Don't assume normalcy. Don't assume quick resolution. Plan for extended disruption. Second, silver is at the intersection of energy, industry, and monetary demand. The Hormuz closure affects all three. It raises mining costs. It disrupts industrial supply chains. It triggers safe haven buying. The three streams converge to push prices higher. Third, the path to $120 is not a straight line. It requires escalation through the scenarios I outlined, but each day of closure increases the probability of those scenarios materializing. Time is working against the bears. Fourth, physical silver is your priority. In a crisis, paper claims are uncertain, counterparties can fail, exchanges can declare force majeure, ETFs can invoke cash settlement clauses. Physical metal in your possession is the only exposure that carries zero counterparty risk. Fifth, act decisively but not recklessly. Don't lever up. Don't bet money you can't afford to lose. Don't assume any particular outcome. But if you've been waiting for a signal, if you've been holding cash for a buying opportunity, the opportunity is now. Crises don't wait for convenient timing. The Strait of Hormuz is closed. Every day it stays closed, the economic damage compounds. Every day it stays closed, the probability of escalation increases. Every day it stays closed, the price of silver rises to reflect a world where supply chains are fragile, energy is scarce, and hard assets are the only reliable store of value. We may look back on this week as the beginning of the silver repricing event that I've been discussing on this channel for years. Or we may look back on it as a scare that passed without consequence. I don't know which outcome will materialize, but I know which outcome I'm positioned for. And I know that being positioned early, even if it means enduring volatility, is better than being positioned late or not at all. This is JonCashFlow. Hormuz is closed, silver is moving, the crisis is real, position accordingly, and I'll see you in the next one.